Today, we're going to break down what is, without a doubt, the single most important rule in trading. This is the absolute core of how markets are structured, and I promise you, once you see it, you are going to have a serious edge. So let's just dive right in.
So, let me ask you a question. Have you ever been there, just staring at a live price chart? The candles are flickering, the price is jumping all over the place, and you just feel completely and utterly lost. If you felt that, you're not alone. Trust me, it's a universal feeling for just about every trader starting out. And here's the honest truth about why that happens. In the heat of the moment, a live chart just feels like pure chaos. The real kicker is hindsight, right? What looks like a super obvious trend when you look back at a historical chart is anything but obvious when you have to make a decision right now in real time.
Okay, so first let's really dig into this idea of the deceptive chart. We're going to break down exactly why this happens and how so many traders, even some folks who've been doing this for a while, get caught in this exact same trap.
Think about it. Looking back, anyone can point out the trend. It's so easy to say, oh yeah, the price was obviously going up here. But when you're in a live market, you have absolutely no idea what's coming next. And without a solid system, you're basically just guessing. And we all know, guessing is a losing game.
But what if there was a foundational rule that could just cut through all that noise? A simple way to see the market's true direction that, honestly, a lot of traders either skip over or just flat out don't know exists.
And that rule? Well, it's all about understanding one core concept: market structure. This is it. This is the foundation that unlocks real clarity and gives you the framework for pretty much any successful trading strategy out there.
So what even is market structure? To put it simply, it's just the pattern of peaks and valleys, the highs and the lows, that the price makes as it moves along. Think of it like the market's blueprint. If you can read the blueprint, you can understand where it's probably headed. Now, you probably already know the textbook stuff, right? An uptrend makes higher highs and higher lows, and a downtrend makes lower lows and lower highs. It seems simple enough. But here's the thing. That definition is missing one critical detail that changes absolutely everything. And here it is. This is the rule that matters most. A low is only official. It's only a valid low once the price actually breaks above the previous high. I'm telling you, this one concept is a complete game changer for reading a chart. Okay, so let's put this uptrend rule into practice. Using this the right way is literally the difference between following a real, confirmed trend and getting totally suckered into a deceptive fake-out. Let's picture a really common scenario. The market's in a nice, clear uptrend, but then it starts to pull back. It creates a dip, and this is the moment where so many traders make a huge mistake. They see that dip, they panic, and they think, oh no, the trend is reversing, and they start selling. But here's why they're wrong. Look on the left. You see that false reversal? That dip is not a validated low. Why? Because the price never broke the old high. The trend is still bullish. It's only on the right, once the price actually pushes past that previous high, that the new low gets confirmed and the uptrend officially continues. See the difference? So this creates a really simple, repeatable process. First, you mark the last validated low. The trend is bullish as long as the price stays above that level. Then, once the price breaks and closes above the prior high, that new low becomes validated. It becomes your new line in the sand. You just keep doing this, moving your critical support level higher and higher as the trend moves up. All right, now that we've got the upturn down, let's just flip the chart. The exact same logic applies when the market's going down, just, in reverse. So, the rule for downtrends is a perfect mirror image. A peak is only confirmed as a valid high after the price moves down and breaks below the previous low. It's the exact same principle, just flipped upside down. And this, of course, presents another classic trap. The market's trending down, but then you get this little rally that gives a flicker of hope. And traders think, this is it, this is the bottom. And they start buying, thinking the whole downtrend is finally over. But again, that high isn't validated yet. In that false rally on the left, the market is still fundamentally bearish because the price hasn't broken the previous low. It's only when it does, like you see on the right, that the new high gets confirmed, telling you loud and clear that the downtrend is still in charge. So,
let's talk about what this really means for you. This is your new trading edge. Applying this one simple mechanical rule gives you an objective advantage. It replaces all that emotional guesswork that just plagues most traders.
And I really can't stress this enough. If you truly internalize this one concept of validating highs and lows, you are putting yourself so far ahead of a huge number of other traders out there who just don't see the market this way. This is your new edge. You get to see the market's real direction. You can filter out all those fake reversals that trap everyone else, and you can finally trade with the kind of confidence that comes from a clear, logical framework. You can actually stop guessing.
So this is the foundation. It gives you the blueprint of the market. And the real question is, now that you can see the structure that so many others can't, what are you going to build with it?